Yo, what's up guys? Welcome back to the channel. I want to show you 3 stocks I just picked up here in my MooMoo portfolio, and what's significant about that is once I buy a stock in here, I'm never going to sell it for the rest of my life. So if you want to come back to my channel in 5 to 10 years or something, I will still own all my shares plus whatever I've added to it. But if you're wondering how has this strategy worked out for me so far, well, our total position profit and loss is plus $81, so we're basically at break even. So only time will tell if this strategy will really pay off, because I have some stocks that are down 51% right here that I'm never going to sell, but I still love Perion Network. They're debt-free, amazing company, but that's not the company I bought. I'll go ahead and show you the first company I bought. I actually bought 1 share of Nike today. I made it my 9th share. Yeah, so I now own 9 shares of Nike, and I honestly think anything under $95 will end up being a very good cost basis for Nike stock, because remember, just a quarter ago, this stock was $120, and the fundamentals haven't really changed too much, but we'll dig into their financials later. I want to show you exactly why I bought Nike stock. The other stock that I bought today was ticker symbol DOCU. I bought my 10th share of DocuSign stock, and I haven't bought this one for a while. Remember, I bought the shares way back in the October low back here. I haven't touched it since. They have gone through some crazy news. Remember, they were going to get bought out at one point. Then the deal didn't go through. And then it went from $62 down to $51. Then it recovered. So I decided to pick up a share today at $53. This company reports earnings in 2 days. So I guess we'll find out in 2 days if this was a good move. But either way, if it's not a good move, I think this company is a great long-term stock, and I will not be selling my shares. They're trading at a 15 times forward net income. So for 2024's net income, they're trading at 14 times that. So DocuSign's a pretty fair valuation in my opinion. And how is the 5-day looking? Okay, so yeah, the 5-day looks pretty bad, so that's why I picked up a share. But anyway, the last stock I picked up, but I'll show you why later, I picked up 1 share of CubeSmart at, way up here at the top at $43. My cost basis is down here at $40, but check this out. CubeSmart, I now have 25 shares of this, and they are my second REIT and my second largest dividend payer. So if I scroll out over here to my Robinhood portfolio, my other REIT that I own, the Real Estate Investment Trust, is Realty Income. So remember how I was up 5% on my CubeSmart, I believe? So 5.58% on CubeSmart. Over here on Realty Income, we're up 4.89%, and we have an incoming dividend from them of $7.61, and this is a monthly dividend I get. So assuming they never grow the dividend, I will get $7.61 for the rest of my life thanks to this investment. But anyway, the point of this video is I want to show you the financials of Nike, DocuSign, and CubeSmart, because these are 3 core holdings in my never sell position. So the first stock I want to talk about is actually Nike, but this is a pure financial analysis. I will quickly mention that people are saying that Nike got the deal of a lifetime with this. For only $28 million, Caitlin Clark signed an 8-year deal with them, and she gets her own shoe, and people are saying Nike got a fantastic deal on this. Like, it's worth way more than $28 million. But anyway, let's get into the financial analysis on Nike. This isn't technical analysis either, and if it was technical analysis, then this is a pretty good sign over the past couple of days. They've been breaking out this channel. But anyway, let's go ahead and dig into the dividend stats. So this company pays a qualified dividend, so that means for me, whenever I receive dividends from them, they're tax-free for my income bracket, but the company pays you 37 cents every single quarter. And let's see how much net income per share they make. So this is the EPS, the net income per share, and they made 76 cents in the most recent quarter, and that well covers the 37-cent dividend. And I think the stock is down because the EPS and the net income is down 3% year over year, and the net income is down 5% year over year. Why was the EPS not down as much as the net income? That's because this company is buying back a bunch of their own stock. We'll get into that later. So this company is paying dividends and does stock buybacks. So let's check out down here their free cash flow. If you average out the 4 quarters, these 4 quarters right here, they make well over $1 billion every single quarter. They actually make more free cash flow than net income. But check this out, their dividend every single quarter cost $562 million, which they can easily afford that. And Nike also has $9 billion of cash, which is up 20% year over year. So $9 billion of cash, and the total debt the company has is also $9 billion. So they literally have just as much cash as debt. So they're very financially stable. And if we go to the total common shares outstanding, you now own 1.88% more of the company on top of the dividend yield. And remember how I said the company does a lot of stock buybacks? Well, the company is spending nearly $1 billion every single quarter on stock buybacks. So remember how I said they only had $9 billion of cash on hand? That's after paying out the stock buybacks and after paying out the dividends. So this company, if they wanted to, could retain a lot more of their earnings, and they have been. That's why their cash is up 28% year over year. So anyway, that's kind of my thoughts on Nike. Their brand recognition is huge from all over the world, and I don't think they're going anywhere for the next 50 years. So that's why I made them part of my buy and never sell portfolio. And if we head over here is kind of the last thing I'll show you. They have a free cash flow yield of 4.34%. Remember, they have a dividend and the payout ratio is 43%. That's actually a lower payout ratio than McDonald's. But if we head over down here, some important metrics I like to look at: the return on invested capital of 19% is very good, free cash flow margin of 12%, but that's enough of Nike. All right, so the next stock I bought is actually DocuSign stock, and I think this company will really impress you guys, and they report earnings in 2 days, so be careful with this one. But the forward PE is 16, and based off my calculations, they're actually trading at a 14 times forward PE and a 10 times free cash flow. So this company is trading at just around 10 times their free cash flow, and here's their free cash flow per share. So they make well over $4 per share a year, and you do a multiple on that. But just in the most recent quarter, it was up 95% year over year to $1.31. But this is looking at their free cash flow. The more important metric is probably their net income per share, or their EPS. And that's because this company just went profitable. If you just looked at their free cash flow, you'd be like, oh, they're always profitable, but we got to look at their net income per share. So this company is finally net income positive. They used to lose, $20-30 million a quarter, and to see that they're now net income positive is a really good sign. And check out their balance sheet. Their assets to liabilities ratio went from 79% to 61%. And I forgot to mention, DocuSign is completely debt free. So here's their free cash flow: $270 million in one quarter. The company does not pay a dividend right now, but guess what? Because of that, they're able to pay off all of their debt, and they have $700 million of cash. And if you're like, well, why did it go down so much in the most recent quarter? Went from 1.2 billion to 800 million. Well, that's because they actually paid off all of their debt completely. So look at this. Since forever, they've had this $700 million of debt. In the most recent quarter, they decided to completely pay it off. And since they have $800 million of cash left over after paying off all of their debt, they're keeping this money in the T-bills, in the money market funds, and they made $20 million of pure free cash flow, pure interest, the highest it's ever been. So this is a company that's actually benefiting from high rates. But whenever high rates go down, this company will benefit from the low interest rate environment, and the valuation will go up. That's just my opinion. Let me know your thoughts about that. So yeah, that's kind of my thought process behind DocuSign. The forward PE ratio, the multiple on their free cash flow is very fair. So that's why I really like DocuSign. And for the very last stock that I bought, I'll make this one a little bit quicker because I feel like not many people like this company, but I love the self-storage industry. It's recession resistant, and this company has done amazing since 2019 while paying a 4.75% dividend yield, and they still have a ton of room to raise the dividends. So let me just show you that right here. This is the metric you want to look at for REITs. You never look at net income for REITs because of how they're taxed. If you did, look, they made 41 cents and their dividend per quarter cost 51 cents, so they could never afford that. That's why you actually look at the core FFO, or the free cash flow, which is up 10.66% year over year. But anyway, the point of this is you want to make sure this is always above the dividend cost. So it was 66 cents in the quarter before, it was 65 cents. And as we can see, it's well above the 51-cent dividend. So this company actually has to pay out 90% of their taxable income by law because of how they're taxed. That's why you don't look at the net income. But look, $150 million in the most recent quarter. And let's see how much their dividend costs from that. It literally only cost $115 million. And has the company been diluting you? No, you've literally only been diluted 0.17% year over year, which is literally nothing. And for a dividend paying stock to not be diluting you is very impressive. So anyway, guys, thank you so much for watching. Hope you leave a like on the video because it really does help me out a lot. And see you on the next one.